Good morning, everybody. Thank you for joining us and welcome to this webinar. I'm Barri Graham. I am one of NQA's ISO 27001 information security assessors. Hopefully there's a few joining us today who I've met so far in my travels, and I hope that I have the pleasure of meeting some of those who haven't met me yet during the course of the next year. Today, I'm going to be examining risk assessments and attempting to uncover some common myths surrounding risk and the process as required by ISO. Though this is an ISO 27001 specific webinar, the process should hopefully be applicable to other management systems you have in place, or assist you in thinking about ways to make this process a part of the fabric of your routine activity within your business. As you've already received an email from the marketing team, I'm sure you've already seen the areas we're aiming to cover, and we'll go into that in more detail as we go through. But as a quick refresher, we'll be looking at information security risks, methodology, identification of risk, performing risk assessments, treatment of risk, and reporting of risk. Additionally, you can also, if you have not yet received this, download for free the ISO 27001 implementation guide from the NQA webpage, and this should handrail you through how to utilize an effective ISMS. It's really a worthy document to have in your system. I can't recommend it highly enough, no matter what level of maturity your system is at. There is the facility to ask questions during the webinar. But I would like, if it would be possible, to keep all questions to the end so we can address them in detail. There is going to be ample time on conclusion of the slide deck to pick up any questions which you haven't covered during the main body of the webinar. So don't worry if we skip something and you want to pick that up later down the line. Finally, I'll just remind you that you will all receive a full copy of this recording and of the slide deck once the webinar is complete. Well, now that we've put down the foundations, let's get on with what we've got to do. So, a bit of marketing stuff. NQA has offices right across the globe. We have experience stacked in all of them, so you're in safe hands. You can see here, we work with a variety of clients from single management systems to complex multi-site organizations. NQA is able to tailor their approach to support each individual client, and we make a unique price promise to our customers. So into the main body of the webinar now. Information security risk management methodology are the rules for conducting the risk assessment. Now, these are your rules, the rules within your business, which obviously can differ from industry to industry and from sector to sector. The identification of information security risks, what kind of things are threats, what kind of things can be classed as threats, okay? Performing InfoSec risk assessments, you need to consider when to perform your risk assessments, at what stage, and how you're going to follow that through. The treatment of risk, we'll be having a look at how to control risks and the options available, and we'll drill into each of those options. There are 4 on how to treat risk, but how you do that is entirely up to yourself, again, based on your industry or sector and the sensitive nature of the risk you've identified. And finally, reporting. Then we'll have a look at how to report on risks to avoid risks being overlooked or deemed too complicated to control. ISO 27001 formally specifies an information security management system, which is a suite of activities concerning the management of information risks, also called information security risks in the standard. The ISMS is an overarching management framework through which the organization identifies, analyzes, and addresses its information risks. The ISMS ensures that the security arrangements are fine-tuned to keep pace with the changes to the security threats, vulnerabilities, and business impacts. An important aspect in such a dynamic field and a key advantage of ISO 27001's flexible risk-driven approach. The standard covers all kinds of organizations, and it's not unique to a specific sector or industry. So, for example, commercial enterprises, government agencies, and non-profits can all find information within the standard which is applicable to them. It also includes all sizes, from micro businesses, one-man bands, right the way through to huge multinational organizations. And it also covers all industries and markets, for example, retail, banking, defense, healthcare, education, government, etc. It's clearly a very wide brief. ISO 27001 is an information security standard that helps companies come into compliance with international best practice models. The standard covers three components of data security: people, processes, and technology. When steps are taken to safeguard data with these three components in mind, businesses are better equipped to protect information, mitigate risk, and rectify procedures that are deemed ineffective. As such, a growing consensus has emerged in the corporate sector that deems ISO 27001 to be the gold standard in best practice schemes. By putting the ISO 27001 standard into effect, an organization activates an information security management system that works within the business's culture of the company in question. The standard is regularly updated and enhanced, and these ongoing improvements allow the ISMS to stay abreast of changes in both within and outside of the company, all the while spotting and eliminating new risks. We won't be covering it during this webinar, but obviously the ISO have released a GDPR bolt-on to the 27001 standard, and more information is available if you go through the website. It's something I'll be happy to answer questions on at the end. So ISO 27001 is designed to support the confidentiality, integrity, and availability of your information and help you to maintain legal compliance. It helps you to protect your data from cybercrimes, misuse, fire theft, and other threats. Having a certified ISMS in place will give you and your customers more confidence in your company, as well as improve your relationships with stakeholders and help you to mitigate risk. A common example of confidentiality would be an online transaction conducted over secure methods, such as the use of encryption, where information is protected via HTTPS domains. As for integrity, a good example to think about would be the trustworthiness of customer financial account information, for example, bank accounts, personal information, etc., which are held by the bank for conducting daily operational transactions. Finally, availability. This could pertain to a bank's customer-facing web servers that host the online banking portal for which customers can access any time of the day. So quickly look at definitions, which we're going to be used on screen. You can see the major contributing definitions. Just a quick read of those. I'm not going to go into them. And then what we're examining throughout the webinar is risk assessment and risk treatment, and we're going to drill into these in more detail. A systematic approach to information security risk management is necessary to identify organizational needs regarding information security requirements and to create an effective ISMS. This approach should be suitable for the organization's environment and in particular should be aligned with the overall enterprise risk management. Security efforts should address risk in an effective and timely manner where and when they are needed. Information security risk management should be an integral part of all information security management activities and should be applied both to the implementation and to the ongoing operation of an ISMS. Information security risk management should be a continual process. The process should establish the external and internal context assess the risks, and treat the risks using a risk treatment plan to implement the recommendations and decisions made. Risk management analyzes what can happen and what the possible consequences can be before deciding what should be done and when to reduce risk to an acceptable level. So now we're going to look on screen. You'll see the considerations given to information security risk management, how the contribution. We'll examine consequence and likelihood in far more detail as we go through the slide deck, and we'll try to illustrate how this can apply to your business and examine ways in which you can make this a palatable process and something that's easy to digest and communicate across your organization. Some more factors are listed there. You'll notice a recurring theme within the last couple of slides of monitor and review. We can't emphasize enough that risk management is not a one-time thing, it's an ongoing process, it's cyclical. So once a treatment has been implemented, you go back to the start to assess if the risk is still applicable and pertinent to your operations. So now we'll look at risk methodology, and we'll examine context and risk management approach. And these are the first steps on your voyage through risk management. You first need to define rules on how you're going to perform the risk management, because you want your whole organization to do it in the same way. The biggest problem with risk assessment happens if different parts of the organization perform this activity in a different way. There's got to be uniformity. Context, the internal and external context for information security risk management should be established, which involves setting the basic criteria necessary for information security risk management. It's essential to determine the purpose of the information security risk management, as this affects the overall process and the context establishment in particular. Depending on the scope and the objectives of the risk management, different approaches can be applied. The approach can also be different for each iteration. An appropriate risk management approach should be selected or developed that addresses basic criteria such as risk evaluation criteria, impact criteria, and risk acceptance criteria. Additionally, the organization should assess whether necessary resources are available to perform risk assessment and establish a risk treatment plan. Define and implement policies and procedures, including implementation of the controls selected, and we'll examine controls in more detail later in the presentation. Monitor those controls and monitor the information security risk management process. Next, we'll look at the risk evaluation criteria. Risk evaluation criteria should be developed for evaluating the organization's information security risk, considering the following: the strategic value of the business information process, the criticality of the information assets involved, and operational and business importance of availability, confidentiality, and integrity. And again, those three things will be a recurring theme. Stakeholders' expectations and perceptions, and negative consequences for goodwill and reputation. And it doesn't take much of a Google search to understand negative consequences and reputational damage from not identifying risk. Additionally, risk evaluation criteria can be used to specify priorities for risk treatment. So impact criteria then. Impact criteria should be developed and specified in terms of the degree of damage or costs to the organization caused by an information security event which considers the following: the level of classification of the impacted information asset, breaches of information security, for example, loss of confidentiality, integrity, or availability, impaired operations, whether that's internal processes or third-party interactions, loss of business and financial value, disruption of plans and deadlines, and damage of reputation. Again, this reputational damage is a common theme which we examine. And finally, within this process area, we have acceptance criteria. Risk acceptance criteria should be developed and specified. Criteria for acceptance often depends on the organization's policies, goals, objectives, and the interests of stakeholders, which must be identified. An organization should define its own scales for level of risk acceptance, and we'll examine some examples of how this is done later in the presentation. The following should be considered during the development of this. Risk acceptance criteria can include multiple thresholds with a desired target level of risk, but provision for senior managers to accept risks above this level under defined circumstances. Risk acceptance criteria can be expressed as the ratio of estimated profit or other business benefit to the estimated risk. Different risk acceptance criteria can apply to different classes of risk. Risk acceptance criteria can include requirements for the future additional treatment. For example, a risk can be accepted if there is approval and commitment to take action to reduce it to an acceptable level within a defined time period. We'll examine again as we go through how this plays out in reality. Acceptance criteria can differ according to how long the risk is expected to exist. For example, the risk can be associated with a temporary or short-term activity. Risk acceptance criteria should be set up having considered the following, which you can see on screen there: business criteria, operations, technology changes, financial constraints, and social and humanitarian factors. So these are the rules governing how you intend to identify risks, who you assign risk ownership to, how the risks affect the confidentiality, integrity, and availability of information, the method of calculating the estimated damage of each scenario, and then the likelihood of it occurring. And now we will drill more into those last couple of points to examine identity of risk. The purpose of risk identification is to determine what can happen to cause a potential loss and to gain insight into how, where, and why this loss can happen. Risk identification should include the risks, whether or not their source is under the control of the organization, even though the risk source or cause is perhaps not evident. Identifying the risks that can affect the confidentiality, integrity, or availability of information is the most time-consuming part of the assessment process. Following an asset-based approach can help developing a list of information assets is a good place to start. But if you find an existing list, most of the work will already be done. An asset is anything that has value to the organization and which, therefore, requires protection. For the identification of assets, bear in mind that an information system consists of more than hardware and software. There's all kinds of things which go around that. Asset identification should be performed at a suitable level of detail that provides sufficient information for the risk assessment. The level of detail used on the asset in identification influences the overall amount of information collected during the risk assessment. An asset owner should be identified for each asset to provide responsibility and accountability for the asset. The asset owner perhaps does not have property rights to the asset, but does have a responsibility for its production, development, maintenance, use, and security as appropriate. The asset owner is often the most suitable person to determine the asset's value to the organization. And moving forward, obviously. Identifying the value of the asset is important to establish a control for a risk. A threat has the potential to harm assets such as information, processes and systems, and therefore organizations and businesses as a whole. Threats can be natural or human origin and can be accidental or deliberate. Both of these things should be identified and considered. A threat can arise from within or from outside of an organization. Threats should be identified generically and by type. Good example, unauthorized actions, physical damage, technical failures, and environmental concerns. Then, where appropriate, individual threats within the generic class identified. This means that no threat is overlooked, including the unexpected, but the volume of work required is limited. Some threats can affect more than one asset. In such cases, they can cause different impacts depending upon which assets are affected. Input to the threat identification and estimation of the likelihood of occurrence can be obtained from the asset owners or users, as we've discovered, who understand the value. They can also come from human resources staff, from facilities management personnel and information security specialists, physical security experts, legal departments, and other relevant organisations and bodies, including legal firms, weather authorities, insurance companies, and government bodies. Aspects of environmental and culture should also be considered when addressing threats. Internal experience from incidents and past threat assessments should be considered in the current assessment. And the final column, vulnerabilities, and we broke it down into what those look like on screen. Vulnerabilities, can be identified in following areas: organizational vulnerabilities, process and procedures, management routines, which are often overlooked, personnel, physical environment, information system configuration, hardware, software, or communications equipment, dependence on external parties. The presence of a vulnerability does not in itself cause harm, as there needs to be a threat present to exploit the vulnerability. A vulnerability that has no corresponding threat may not require the implementation of a control, but should be recognized and routinely monitored for changes. It should be noted here that an incorrectly implemented or malfunctioning control, or a control being incorrectly used, can itself be a vulnerability. A control can be effective or ineffective depending upon the environment in which it operates. Conversely, a threat that does not have a corresponding vulnerability may not result in a risk. As a way of wrapping up this slide, you must identify the threats and vulnerabilities that apply to each asset. For instance, if the threat is, for example, a common one, the theft of a mobile device or the loss of a laptop, the vulnerability is lack of formal policy for mobile devices or lack of policy for correct use of laptop company assets. After you've done this, you should assign impact and likelihood values based on your risk criteria. You could use severity instead of impact and probability instead of likelihood, so the terminology is entirely down to you, whatever makes it palatable to you, your business, your culture. However, the process remains the same. Once you know the rules, you can start finding out which potential problems could happen to you. You first need to list all of your assets, then the threats and vulnerabilities related to those assets. Assess the impact and likelihood for each combination of asset, threat, and vulnerability. And finally, you can calculate the level of risk. From experience, being out assessing, companies are usually aware of only 30% of the risk. The process they've gone through is often correct, but they haven't considered all of the risk factors, and therefore they don't capture all of the risks which apply to their company. You'll probably find this exercise quite revealing if you first list complete list of assets within your company and then go through the threat and vulnerability methodology, which we'll go on to in the next slide. Once you've finished doing this once, you'll appreciate the effort you've made, and you really will start to see some of the gaps in your risk radar, if you like. So let's have a little look at, as I previously mentioned, a laptop and how to identify risk from this asset. So one asset may have numerous threats and then a number of vulnerabilities, and all of those are on screen now. The key thing to identify is all risks associated with certain assets and also the vulnerability posed by these risks. So the theft and malfunction piece are two different threats for the same asset. So hopefully you can see that there are multiple threats and then multiple vulnerabilities from those threats from just a single asset. Excuse me. You need to weigh each risk against your predetermined level of acceptable risk. For example, this could be called your risk appetite. And this determines which risks you need to address and which ones you can ignore. This is one of the more common examples, which is a 5x5 matrix, a fairly simple one to follow. There are others available, such as 3x3, and I've even seen a 10x10 matrix. It depends on your organization and how you want to proceed. So we'll just examine a 5x5 because it's a fairly common matrix with the impact along the side with numerical values of 1 to 5 and likelihood along the bottom, again with numerical values of 1 to 5. From here, you can determine the overall risk rating as high, medium or low, and they've set their threshold for low as under 5, between 5 and 14 as medium, and 15 plus as being high risk. So now we'll take a quick look at quantitative or qualitative. There's a number of ways of looking at this. It depends on your organization and what level of risk you're dealing with and how you identify your risk, whether it's data-based or perception. And we'll have a look at two different ways of doing this now. So quantitative risk analysis uses a scale with numerical values rather than descriptive scales, which are used in qualitative risk for both consequences and likelihood, and uses data from a variety of sources. The quality of the analysis depends on the accuracy and completeness of the numerical values and the validity of the models used. Quantitative risk analysis, in most cases, uses historical incident data, providing the advantage that it can be related directly to the information security objectives and concerns of the organization. A disadvantage is the lack of such data on new risks or information security weaknesses. Disadvantage of the quantitative approach can occur where factual, auditable data is not available, thus creating an illusion of worth and an accuracy of the risk assessment. In financial terms, quantitative risk assessments include a calculation of the single loss expectancy of monetary value of an asset. The way in which consequences and likelihood are expressed and the ways in which they are combined to provide a level of risk will vary according to the type of risk and the purpose for which risk assessment output is to be used. The uncertainty and variability of both consequences and likelihood should be considered in the analysis and communicated effectively. Qualitative risk analysis uses a scale of qualifying attributes to describe the magnitude of potential consequences, for example, low, medium, or high, and the likelihood that those consequences will occur. An advantage of qualitative risk analysis is the ease of understanding by all relevant personnel, while a disadvantage is the dependence on subjective choice of the scale. These scales can be adapted or adjusted to suit the circumstances, and different descriptions can be used for different risks. Qualitative risk analysis can be used as an initial screening activity to identify risks that require more detailed analysis, where this kind of analysis is appropriate for decision making, and where numerical data or resources are inadequate for quantitative risk analysis. So there's always a way to attack a risk. Qualitative analysis should be factual based and data could be used where available, although as we've discussed, this is not always the case. Assigning probability and impacts to risks is a subjective exercise. Some of this subjectivity can be eliminated by developing rating scales that are agreed upon by the organization, and this is something I see fairly regular. Generally speaking, an organization must define impact and likelihood levels that are relevant to the business. ISO 27001 and ISO 27005 Do not state whether these levels should be quantitative or qualitative, high to low, 1 to 5, 1 to 100, or otherwise. The most important thing is that people understand the scoring in business terms and how it applies to your organization. Impact is usually measured in terms of confidentiality, integrity, or availability, and may include financial, reputational, and regulatory impact. Also, information security and operational impacts. Once you've analysed your risks, you need to evaluate them to establish where they fit in terms of your risk appetite. Only once you've done this can you decide the appropriate way to treat each risk. This means you should be able to quickly identify your highest risk and create a prioritised list of which risks to address and in what order. It's particularly important to identify whether or not the risk falls within or outside your predetermined level of acceptable risk. When risk owners say that they will accept a risk of, for example, if you think back to the matrix, 9, they must be prepared to accept a business situation such as the loss of X amount of pounds every year, rather than the less relevant impact of 3, likelihood of 3. In practice, there is a link between the impact and the threat, vulnerability and likelihood, as similar threats tend to produce impacts on business and similar vulnerabilities produce similar likelihoods. Impact types could include human, financial, legal, regulatory, reputational, and operational impacts. Likelihood factors could include frequency of occurrence, previous occurrence, current levels of security control, the size of the attack group, and knowledge of the vulnerability. As way of illustration now, hopefully the following pyramid will bring to light what we've covered and provide you an approximate guide to help visualize your own business risks and how they may be pertinent to your organization. The columns and the numbers on the right of the chart there are by no means illustrative or an example or a handrail. It just gives you a quick overview of what may be catastrophic or major or minor, for example. The numbers, again, are arguably subjective and will change from business to business and organization to organization. As long as you've considered what the impact is and then make it applicable to your business, and make it sellable to top management. That's the main thing. Of course, not all risks are created equally. You have to focus on the most important ones, the so-called unacceptable risks, which break the threshold at which you accept. There are 4 options you can choose to mitigate each unacceptable risk. So modify is the application of security controls from Annex A within the standard to decrease the risks, and we'll have a little look at this in more detail. But there's 3 other options. It's not always a case of treating a risk. You could transfer the risk to another party. A good example is to insurance companies by buying an insurance policy. You could avoid the risk by stopping an activity that is deemed too risky, or doing an activity in a different fashion to eliminate the risk you've identified. Or you can accept the risk if, for example, the cost of treating a risk is higher than the actual damage output would be. This is where you need to get creative. So far, we've examined the scientific approach to risk, but here it's more of an art form. How to decrease the risk with minimum investment is the key. It would be the easiest, if your budget was unlimited, but that's never going to happen, and it never has happened. And I must tell you that unfortunately your management may be right. It is possible to achieve a result with less money. You need to figure out how. So we'll examine now risk treatment in more detail, because this is the one that obviously may be applicable in more circumstances than not. And treatment is the process used to ensure information risks are reduced to an acceptable level, to leave a residual risk after treatment which is acceptable. Actions should be in line with the level of risk posed to the information assets, normally by adding strengthening security controls that will reduce likelihood of vulnerability. Now, those of you familiar with ISO 27001 will know that at the back at Annex A, there are a number of control measures, 114 in all, which over 14 clauses and 35 control categories. We'll just skirt through each one. I'm not going to go into a tremendous amount of detail on each one, but we'll just cover each of the headlines, if you like, for the Annex A controls. Beginning with Alpha 5, information security policies. And these are controls on how policies are written and reviewed. Organization of information security, these controls on how the responsibilities are assigned across the business, and also includes the controls for mobile devices and teleworking, which is an increasingly prevalent part of business life. Alpha 7, human resources security, which controls considerations prior to employment, during and after the employment, to ensure that non-disclosure agreements, for example, and things are reflected in contracts which outlive the stay of the employee within the company. Asset management, which are controls related to the inventory of assets, which we've established is perhaps a good start point for all risks, their acceptable use, and also the information for classification of media handling. 9, access control for access control policies, user access management systems, application access control, and responsibility for users. 10, cryptography is fairly self-evident. 11, physical environmental security, which are controls which define secure areas, entry controls, protection against threats, equipment security, secure disposal, clear desk and clear screen policies. Operational securities have lots of controls related to management of IT production, change management, capacity management, malware, backup, logging, monitoring, installation, vulnerabilities, etc., etc. And communication security at 13, controls related to network security, segregation, network services, transfer of information, messaging, etc. 14, system acquisition, which is develop and maintenance. Controls define security requirements and security and development and support processes. Supplier relationships, control on what to include in agreements and how to monitor the suppliers to ensure compliance. Incident management, which the controls within for reporting events, weaknesses, defining responsibilities within those parameters, response procedures and collection of evidence. So business continuity management is next, and Alpha 17 looks at the controls requiring the planning of business continuity with information security aspects in mind. Most businesses and organizations have a BCP, a business continuity plan, and it's something that's part of the fabric of their being. However, specific information security requirements within that are detailed at Alpha 17. And finally, Alpha 18, compliance, which are controls requiring the identification of applicable laws, regulations, intellectual property protection, personal data protection, and reviews of information for security. I do know that before we started the webinar, there were a few questions thrown into the marketing team about compliance. I've got an answer for those, and we'll cover them along with all of the other questions on conclusion. So Annex A of 27001 sets out 114 good practice security controls. The controls use the word should and are neither mandatory nor exhaustive. This means that organizations with differing risks will apply these controls to different levels of strength. Although ISO 27001 doesn't require you to use the Annex controls exclusively, you do have to check the controls you select from elsewhere against those in Annex A to ensure that each risk is appropriately mitigated. Now, having selected your controls, you need to produce a statement of applicability, or SOA, as it's shortened to. This is one of the most important 27001 documents. It should identify the controls you've selected to address the risk you've identified. Explain why you've selected those controls. State whether or not they are currently implemented. And you should also explain why any 27001 Annex A controls have been omitted. It stands to reason then, if there are 114 security controls, there will be at least 114 entries in your statement of applicability, one for each Annex A control, all of which will include extra information about each control and, ideally, link to relevant documentation about each control's implementation. A risk assessment report can be very long, so an SOA is a very useful document for everyday operational use. A simple demonstration that controls have been implemented and a useful link to the relevant policies, processes, and other documentation and systems that have been applied to treat each identified risk. Think of it as an index to your ISMS. This document actually shows the security profile of your company based on the results of the risk treatment. You need to list all of the controls you've implemented, why you have implemented them and how. This documentation is also very important because the certification auditor will use this SOA as a main guideline for the entire audit. So we looked at treat in more detail, but as we first discovered, there are 4 options to risk treatment, which don't include modifying or treating the risk. You could also transfer or share, avoid or terminate, accept or tolerate risks. Generally, by ensuring or outsourcing, you've achieved the share or transfer. Although you would typically still suffer the impact, you could share the risk with somebody better able to mitigate it. This shifts part of the risk to other organisations or contractually to business partners, for example, IT support services. An organisation cannot transfer ownership of the risk. Terminate is the end of the activity or the circumstances causing the risk, for example, by not carrying out the activity or moving the location under which that activity is taking place. This occurs when there is no cost-effective action to reduce the risk. It may involve choosing an alternative activity that meets the same business need. And finally, tolerance or acceptance. This is commonly accepted by management that risk falls within their previously established risk acceptance criteria or via extraordinary decisions. This means that no additional action is required other than what is already in place. However, this still needs to be documented and communicated up to senior management for approval. So risk treatment, this is the step where you have to move from theory to practice. This is the outcome, if you like. Let's be frank, up to now, this whole risk management thing was purely theoretical, but now it's time to show how you're going to do your results. This is the purpose of the risk treatment plan, to define exactly who is going to implement each control, in what time frame and with which budget. I prefer to call this document an implementation plan or an action plan, but the terminology within ISO 27001 says risk treatment plan, so we'll stick with that. Once you've written this document, it's crucial to get your management approval because it will take considerable time, effort, and money to implement all of the controls that you've planned here. Without top management commitment, you're unlikely to get any of these and realize risk treatment. And this is it. You've started your journey now from not knowing how to set up your information security all the way through to having a very clear picture of what you need to do to implement. The closing point is that 27001 forces you to make this journey in a systematic way. And I hope during the course of this presentation that has been brought out. So before we move on to questions, and I can see that I've got a few to answer there along with a few that came in early. There's a few things on screen there about keeping in touch with NQA. Please feel free to visit the website for additional content or the implementation guide, which is available to download. And please do follow us via any of the social media channels highlighted on this slide. You'll always find any employee at NQA to be open and welcoming and happy to answer any questions you may have. And that concludes this slide deck. And now I'll be happy to answer any questions you have about risk, ISO 27001 in general, or ISMS implementation. I will start with the questions which were emailed in ahead of the webinar, and then I'll work through those that have been popping up in the questions box on screen. Thank you. So ahead of this presentation, we had a question about regulation in software industry, and there are numerous legal and regulatory considerations within the software industry which need to be borne in mind. I've not specified legislation in its own right, but there are considerations such as intellectual property rights and licenses, consumer protection, age ratings and classifications, specifically if you're in the gaming industry for software, advertising laws, GDPR, data protection and privacy, and responsibilities concerning staff and employment practices. I will signpost you to some relevant bodies which can bring out in more detail some of the legislation which applies, and these include the Association for UK Interactive Entertainment, or UKIE, which is the UK's leading video games trade body. The Business Software Alliance, BSA, is the trade organisation which represents global commercial software. Federation Against Software Theft, FAST, represents both software publishers, users, and aims to combat software piracy, and there's plenty within their domain which is applicable. And Tech UK, which is the UK's trade body for the IT industry, formerly known as Intellect, which aims to improve growth in the IT industry and provide its members with knowledge and advice. And once again, they can signpost you to some more specific legislation dependent upon your inquiry. And all of those things are pertinent to the Alpha 18 control on compliance. So as long as you've given consideration to those legal and regulatory considerations, then you'll be within the standards guidelines. I hope that answers that one, but if not, please feel free to come back. Okay. So the implementation guide, which was a question asked by Sarah, you can find that on the NQA webpage under, if you go to, I think it's business areas, it's broken down into which standard you're trying to look at specifically, and 9,000, 14,000, and then 27,001. And if you follow the menu down to the bottom of the page, there is a implementation guide on the website. If you're struggling to find it, then by all means do drop us an email and we'll send you a copy straight into your inbox if you can't see that there. Okay, so one from Ken, who asked, following an audit, it's not possible to reduce the impact of a risk in the assessment by having a BCP in place, and you didn't agree. My view is that BCP is a consideration, and information security aspects should be included in your BCP, clearly to meet the needs of Alpha 17. But having a BCP in place does not necessarily reduce the impact of a risk. Just by having that in place, the residual risk and the outcome, you need to treat a risk dependent upon the risk. I mean, I don't have a lot of context, but dependent upon the nature of the risk, you need to reach a state of residual risk following the application of a control. And having a BCP may or may not directly address that, but there's not many examples where just the existence of a document or a process reduces a risk down to an acceptable level. It varies from business to business, but without a little bit of context, I would be unable to fully answer that question. However, if you drop me a line or drop an NQA line with a little bit more information, I'll try and get back to you with a more detailed answer, Ken. So James asks a question about risk acceptance criteria and whether this should be defined from the outset to enable risk assessment and impact assessment criteria to be designed whilst ensuring they fully support the business acceptance criteria. So no, you're quite right in your first statement there, in that risk acceptance criteria, it should be defined from the outset. Simply put, if you know where your acceptance levels lie and what criteria meet that acceptance level from the outset, it that's best practice, because then you can sort of build your treatment around that, because you know exactly what you're looking through. I wouldn't say it's a secondary activity to an assessment criteria. No, just if you understand your acceptance criteria early, then the controls selected to treat whatever risks fall out of that are clearly going to be more defined, if you like, more focused. So I would say the first part of your question there is probably the most applicable. So Noel asks about the GDPR bolt-on. This is something that's ISO. There is an ISO standard which bolts onto the 27001 now. It's not live just yet. I think it's 27702. I'll have to get back to you with the exact number. But essentially, that's implementation of 27001 got you, let's say, plucking a number out there, 80 to 85% of the way in terms of GDPR compliance, and there is a new standard as a bolt-on to 27001, which will be on the website soon. I was obviously signposted to that myself this morning in terms of attending the course to make sure I can audit that. It is coming online. It will be live very, very soon. It's not there yet, but the bolt-on will ensure full compliance with GDPR. You do need the 27001 live and running and working as a management system to have the bolt-on. But yeah, it's not quite there in terms of being live yet, but it will be any week now. So Lindsay asks about examples of risk assessments. Hopefully within the slide you could pick up just enough. Obviously I can't give you a clear answer, because when I come to audit, then obviously I'm auditing my own homework there. But you can see, if you follow the methodology, you get the slide deck delivered to you via email, and hopefully within that you can pick enough out of the presentation to see what a risk assessment is. But as long as you clearly define what you think the risk is, for example, as we saw in the presentation, the loss of a laptop, or the laptop as the asset, and then the threat to that laptop was theft or misuse, and the vulnerability fallout of that theft or misuse consideration. So your assessment then is based on either experience or subjective opinion, qualitative or quantitative. You write down what you think simply is your assessed risk to that, and what you're going to do to treat it. If it's still not clear, Lindsay, then again, by all means, drop us an email, and we'll try and answer that in a more detailed way. But hopefully, if you just sort of flick through the relevant points within the slide, you'll be able to draw out from that what it should look like. And Sarah asked a question about special interest groups and recommendations. And again, when I answered the questions on compliance there, I mentioned a few bodies within the software industry which are cover the needs basically of those who work within that sector. So I'm not sure what sector you work in, but it's a similar thing. If there is a regulatory body or a legal is this piece of legislation, for example, which is applicable to whichever business or sector that you're in, then that would be special interest groups, because they will obviously release magazines, emails, marketing shots. It's when I turn up to audit, it would be not testing, but making sure you're aware that these things are out there, and they may contain information which is pertinent to your business, pertinent to your sector, and help you identify where to go in case you need help. So special interest groups are subjective, dependent upon the sector or business you're in. But if you need more information, then please, again, do let us know with where you are, what you do, and we'll get back to you with some examples of what might be an interest group. Okay, I can't see any more questions for now. I'm just going to stay on the line for one more moment to see if there's any last minute questions which need to be raised. Okay, there are no further questions, then thank you very much for joining us today. I hope you found that useful. If there are other questions which come to you once you've sort of gone offline, if they're not answered within the slide deck you receive, then by all means come back to us with questions that you may have. But thank you very much for joining us, and we'll hope to speak to you soon. Thank you.